Okay, folks. In this video, I want to talk a little bit about a good way, or one good way to buy a sell-off. Over the last few days, I've been getting a lot of, shall we say, inquiries about how to do that. So I thought I'd do a quick video and talk about it, and maybe it'll help some folks out. So the first thing is you need to have kind of a couple of things working for you, right? And nothing fancy, but I'm just going to run through them very quickly. Number one, you have to believe in the long-term upward trend of markets, right? Even when we have sell-offs, you have to kind of believe that ultimately they will come back, right? And I'll show you a couple of charts in a sec to kind of back that up, but you have to kind of have that as a starting point, right? Number two, you have to have a good understanding of how entry mechanisms work, and how certain setups work. Again, something I'm going to point out to you, one of which I'm going to show you and here in just a little bit. But you kind of have to understand how that works, everything from the mechanics of it to the idea behind it. And finally, you kind of need to understand that you may have to do it more than once, right? Speaking of having to do it more than once, the third thing you really need to have is the discipline to do it again, or to stay with it once you're in a position, right? So with respect to doing it again, as swing traders, one of the things that you have to understand is you want to minimize your risk, so that you, at least in part, feel more comfortable taking trades over and over again, if and when they set up, right? Because that is how you get into some of the longer term winning plays, if you will. It's not so much that you have the foresight or you're so prescient as to be able to pick perfect entry spots, such that you don't have to suffer any losses to get into a really good position, right? From my perspective, and I've been doing this for a long time, but one of the things that I do is I think of it as the small losses on the front end of a trade are often the cost of getting into that position, right? So an analogy would be if you run a small business, or if you run a business period, right? The cost of executing your business, whether it be a service business or product-based business or whatever it is, the kind of external cost of engaging in that business are the analogy to the small losses that you have to take to get yourself into a winning trade, or, to continue the analogy, a good product, right? And finally, kind of as a bonus, you really kind of need to have a trading account set up. And the bonus part of this is it will be really awesome if you know how to trade options, simple options, calls and puts, but options, right? Because they allow you to certainly when you trade them kind of straight, for lack of a better phrase, they allow you to pinpoint your risk and be, pretty exacting with respect to that, right? So they don't suffer from some of the same things as gap risk and things of that nature. So at any rate, those are kind of the let's say it's our understanding, right, of the things that you need to have in order to have this work for you, right? Now, very quickly, I'm going to run through kind of some charts. You can see on these daily charts that we've been just getting beaten up pretty badly in the U.S. equity market. The composite down, the Qs down, NASDAQ 100 down. NASDAQ 100 down. The small cap ETF getting smoked. Russell's down. The transportation index down. Bitcoin has taken a beating, right? So it's down. And if I go down to Fangam, Facebook, gap down, still down. Apple has gotten smashed, came back a bit today. Amazon down. Netflix down. Google down. Alphabet down. Microsoft again down, right? So everybody's kind of taking it on the chin here, right? So what I'm going to do now is move to a different chart that will show you or prove to you, I hope, that from a long-term perspective, the markets just want to go higher, right? So if I go back pretty good bit here, you can see that even though they have varying rates of ascent, right? The market is, this was a little bit different, right? 2000 to 2003, 2003. But other than that, right? So the ascent might be fairly modest, and the drops can be, fairly dramatic, but then the ascent starts anew, right? Dramatic drop in March of 2020, but then back to the upside, right? And now we're suffering another drop, right? So the equity markets have a desire to go higher over time, right? Now, how do you get yourself into a position, right? Like back here, or the one that we're going to talk about today is right here, right? How would you go about getting yourself into a position like that? Well, I like to use what's oftentimes called a hammer pattern, but really what it is when you have the market on a weekly basis, and this is the S&P 500, when you have it drop on a weekly basis pretty strongly, right? You want to take what's called the high of the lowest touching bar, right? So when price breaches that high, you want to get long. Your stop is just on the other side of the low here, and then you sit and wait, right? Now there are some, more tricks to the trade, like my preference is to take a long on at least, 2 contracts, and then cut some of my risk as we go higher. It reduces the size of your trade, right? So it reduces your return, but it's a bit safer way to go about taking these trades, right? Because you essentially are able to purchase your risk, right? By selling once you get some traction going in this direction. And then, if price rolls over and ultimately dies and goes down and stops out the back end of your trade, you're really not that much worse for wear. I don't know why this thing is spread like this. Sorry. Couldn't see the other side there, could you? You're really not that much worse for wear, right? So again, right, you want to wait for price to take out the high, meaning trade above the highest point of this candle at which you would get long. And there are a lot of different mechanisms for doing that. I'll talk about some of those in the coming days. You put your stop on the other side here, and you go from there. Now, a couple of things. Number one, this is a weekly candle, right? So you wouldn't be, first of all, this hasn't closed, right? So you would have to wait for it to close. And then you would purchase a tick above the high of this highest point right here, put your stop on the other side, and then just wait and see what happens, right? Remember that discipline that we talked about? And that's how it would go, right? You may have to take it more than once. But if you recall, if you can get into some of these trades, right, on a weekly basis, the returns can be pretty astronomical, right? So oftentimes when you get these pullbacks like this, what it's giving you is an opportunity to maybe get involved, right? One final thing. When markets are falling, a lot of people that participate in the markets act as if they believe that it's never going to go up again, right? You're not going to be able to predict exactly when it's going to turn, which is why you may have to take the trade more than once, right? And it always comes as a surprise. The reversal always comes as a surprise, right? So that's why you want to have a very structured way of getting yourself into the market, so that when that turn does happen, you're there for it and can participate in the upside. Okay? So I hope all that makes sense. If you have any questions, please feel free. Barring that, I'll see you next time. Take care.